All right, so today we're jumping into the latest quarterly report from the tech components maker Maruwa. Our goal here is pretty simple. We're going to cut through all the jargon and really figure out the story behind the numbers. Exactly, because let's be honest, these reports can sometimes hide what's really going on. So the big question for us, and for any investor, is this. Are we looking at a company that's actually firing on all cylinders, or is it just treading water in a pretty tough market? To figure that out, we've got to start with the big headline numbers. Think of it like the company's report card for the first 9 months of its fiscal year. So, how did they do? Okay, first up, the top line, net sales. For the first 9 months, Maruwa pulled in just a hair over 52 billion yen. And out of that, they turned an operating profit of just over 17 billion yen. But of course, numbers this big don't really tell you much without some context. And here's where it gets interesting. See, net sales slipped just a little bit, down 1.7%. Nothing too crazy. But look at the operating profit. That dropped by a much bigger 13.2%. And that gap is the real story here. It tells us that even though they're selling almost the same amount of stuff, they're making a lot less money on it. So the immediate question is, what's going on? And to find that why, you really have to pop the hood and look at the engine. A company like Maruwa isn't just one big thing. It's made up of different business segments. And breaking it down that way is where the real story starts to come out. So with Maruwa, you've basically got two main characters in this story. On one side, you have the ceramic components business. This is their core engine, the absolute behemoth that brings in most of the cash. And then you have the lighting equipment business. It's a lot smaller, yeah, but as we're about to see, it's playing a super important role right now. So let's check in on that big engine first. Ceramic components. Sales were down 3.4%, and the profit from this segment dropped even more, falling 15.5%. Bingo. This is where most of that overall drop in profitability we saw earlier is coming from. So what happened? Well, it's kind of a mixed bag. The part of their business that deals with high-speed communications, that stayed strong. The real weakness came from their auto and semiconductor-related businesses. But, and this is a huge but from the report, both of those weaker areas started to recover this past quarter. That's a really important signal that things are starting to turn around. Okay, now let's flip to the other side of the story, the lighting equipment business. And wow, what a completely different picture. Sales are up almost 10%, but just look at that profit number. It exploded by an incredible 61.9%. I mean, a 62% jump is just massive. So what's lighting this fire? Well, according to the company, it's two key things. A huge demand for their lighting in new high-end condos, and a steady stream of public projects to switch everything over to LED lights. It's just a classic case of being in the right place at the right time with the exact right product. Okay, so what we're seeing is this picture of a recovering giant and a smaller business that's absolutely booming. But profits are only one side of the coin. As an investor, you've got to ask, is the company's foundation actually solid? And for that, we have to check out the balance sheet. And if you had to pick just one single number from that balance sheet to tell the whole story, it would be this one, 92.2%. That is Maruwa's equity to asset ratio. And let me tell you, that is an unbelievably strong and healthy number. So what on earth does that actually mean in plain English? Well, the best way to think about it is like a mortgage. This ratio means that Maruwa owns 92.2% of its entire house, all of its assets, completely free and clear. Only the tiny little bit left over is financed by debt. It's like having a mansion with a mortgage you could pay off with your spare change. It just means the company has extremely low financial risk. A rock-solid foundation is fantastic, but investors are always looking down the road. So what does the future hold? Let's switch gears and look at the company's own forecast to see what they're expecting. And wow, management is not shy about being optimistic. This quote from them is crystal clear. They're expecting growth in their most important business, telecommunications, to actually speed up because they're ramping up production for next-gen technology. That is a seriously confident thing to tell your investors. And that positive feeling isn't just in one corner of the business. They're seeing good signs pretty much everywhere. Telecom is set to accelerate. The auto business, which was dragging them down, is now officially recovering. The semiconductor side is getting a nice boost from all the demand related to generative AI. And that lighting business that was on fire, they expected to keep right on performing. So what's the bottom line here? If you look at their forecast for the entire fiscal year, even with that dip in the first 9 months, they expect to end the year with growth. They're predicting a 4.5% bump in sales and a tiny increase in operating profit. That tells you they are counting on a really, really strong final quarter to pull them across the finish line. Okay, we've looked at the performance, the different parts of the business, the financial health, and what they see coming. So let's wrap this all up. What's the story of Maruwa's quarter in a nutshell? First off, the headline numbers didn't tell the whole truth. The real, much more interesting story was buried in the details of the different segments. Second, you're really looking at a two-speed company right now. The main ceramics business is bouncing back from a slump, while the smaller lighting business is just crushing it, helping lift everything up. Third, the company's finances are about as solid as it gets, thanks to that incredible 92.2% equity ratio. And finally, the outlook is really bright, with management pointing to a big recovery and new tech like AI as fuel for future growth. So back to that first question, thriving or surviving? Well, the data really suggests this is a company that survived a short-term dip and is now getting ready to thrive.
Before we go, we just have to share some important information with you.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.